if you're investing in the stock market as active participant, you know that alpha is the holy grail of investing. Everybody is obsessed with it and everybody wants to achieve it to show the extra performance, the excess performance compared to the broader market. In this video, I just wanted to take a moment to reflect upon my performance to show you how actually alpha is overrated and to underline the fact that in reality, if you want to beat the market, alpha is not that necessary, is not that important, but there are other factors that you need to take into account and that, in my opinion, are very, very, very underestimated. Now, this is going to be an open heart reflection. I'm not going to say everything that I'm about to say to brag. It's just to report my case, hoping that is going to add value for yourself in the way you experience investing, in the way you measure your results, and you can actually organize the overall situation better when it comes to understanding what's going on behind the scenes. In fact, I also wanted to provide the good and the bad from having this type of returns here. If we haven't met before, my name is Francesco Ferrari. I am an independent equity investor, investing coach, and licensed financial educator in Italy. And as you can see, I have been achieving a performance of plus 30.9% in the past 5.5 years, investing in individual companies only in the stock market. Now, you have I reported the screenshot taken from GetQueen, the place where I track, among the other places, the portfolio performance against the QQQ, so the Nasdaq and the S&P 500. This is in euros, so that's because, of course, being in Italy, I invest in euros, and I decided not to hedge against the dollar. That's a topic perhaps for another conversation, but basically, what I wanted to show you is this very simple chart here. So how did I come from a broad market performance of roughly 14% annualized of the S&P 500 to our 31% more or less? As you can see, alpha is not the most important factor here to consider. There are three elements here that contributed to the extra performance, and they are very important for you to understand. Now, this video was actually inspired from a conversation that I had with one of my students. He was managing a portfolio of multi-seven figures, and he was achieving a plus 17, 16.8% annual returns in his portfolio. And he posed the question to myself. He wanted to know better if that return actually made sense, considering the composition of the portfolio, the benchmarks, the choices that he was making, and so on and so forth. So that actually inspired today's video because understanding your returns is very important. And as you can see, the first element here that is incredibly important to factor in is beta. What is beta? If you're an intermediate to an expert investor, you already know. It's the measure of the volatility of your stocks compared to the overall market. And by market, we simply mean the S&P 500. If a stock has a beta of 2 and the stock market goes up 10% in a year, freezing everything else, I can fairly expect my stock to go up 20%, meaning doubling the performance of the S&P 500, just because of the beta. Again, it's an indication of the expected volatility in either direction compared to the market. So if the market drops 20%, assuming everything else stays the same, which is never the case in the stock market, but assuming everything else is the same, my stock should go down minus 40%. If I have a beta of 1, I can expect to track the performance of the overall market by eliminating every other factor. So why is beta so important? Because as you can already imagine, it's a sort of leverage. It's a sort of free leverage that we, as active, independent equity investors, that we love stocks, that we love individual companies, can benefit from. Of course, we need to manage beta with a lot of caution, with a lot of attention, because of course, when the stock market goes down, if we are exposed to a very high beta, the drawdowns will be larger, will be deeper. Okay. And so I'm not saying, of course, that you should be having a beta of 4, because, you know, the narrative could be the stock market always goes up. So why not having a beta of 4, 5, 10, 20, and just benefit from the higher volatility? We need to take into account the downsides moves, the bear markets as well. So if we could be, if we were able to anticipate the stock market moves, of course, this is impossible. But uh, if we could go back in time, we would load the boat on high beta stocks during bear markets at the bottom of the bear markets and cut down beta, bringing it back to 1, ideally, during market peaks. This way, we can leverage the way up, so the bull runs, and experiencing a not so tremendous and not so amplified drawdown during the, the phases where the market goes down. Of course, there is a fine dark line between trying to time the market, which is not possible. We will never going to be able to precisely time the bottom and the peak of the stock market. But, and this goes against the common narrative, we have to try our best to be more dynamic. And that is already the topic for the second block here, which involves the timing of your investments. But remaining focused on beta, it is crucial to remember that when we are experiencing bear markets, normally the best course would be to increase our beta without exaggerating too much, without being too aggressive. Let's say a beta between 1.7 and 2 may be good to have in those situations. Even 1.5 is excellent. And during extended bull runs, perhaps it's better to put a cap on beta and go below 1.5, let's say between 1 and 1.5. Right now, my current beta is 1.39. During 2022, which is where I invested the most amount of money, the moment where I was more aggressive, my beta went up to 2.2. So that contributed a lot when the stock market started welling back and we recovered from the bear market and we experienced 2.53 years of a positive bull market. So that is the first element. And just by optimizing for beta, we can explain, like, the difference between our 31 and the 14% of the stock market can be explained by the beta itself, which brought, according to all the calculations, a 8.9% uh, more returns per year against the broad market, and which is incredible if you think about it, because that only explains 51%, so roughly half of the extra performance just comes from the beta. And we didn't even take into account alpha and timing so far. So that is, I know I'm repeating myself, but I just wanted to deliver this message to you. If you are able to manage beta and optimize it across bear and bull runs, that is massive. It's free leverage. It's just tailwinds when the market goes up. And if you're able to maximize, so to minimize the drawdowns during bear markets, you are doing an incredible job. The second point here is about timing. Again, if you see the red lines here, that's the moment where I invested the most, where I concentrated my moves. So in general, I don't have a specific rule here. Some people are really scientific and systematic here. So when the Nasdaq or when the stock market, when the S&P 500 goes down 15, 20%, they start deploying more money in their positions or in their strategies. Of course, I don't look at the indexes. We don't do that. We invest in our companies, in our holdings. Therefore, we only invest when our stocks provide the best situation to do so. They provide the opportunity. They when they look very asymmetric, when the downside is protected, and at the same time the upside looks promising, and the overall reward to risk ratio is a 10 on 1, meaning I'm risking 1 to make 10. That's more or less the overall picture. And let me say one thing. It's over the past 3 years, doing so, we were able to exactly time the bottom of the market of the correction in the first quarter of 2025 and also in the first quarter of 2026. That is, let me say it openly, that is a coincidence. That's luck. That's a pure coincidence of us investing in our holdings and the stock market bottoming in that specific situation. In 2022, we weren't so lucky, for instance, because I invested the most during Q2 2022, and the bottom occurred in November 2022. And at that particular time, I was not investing that much. And most importantly, I didn't even catch the first part of 2023. In 2023 overall, I didn't make any move. I just let the market go up. Whereas I could, of course, in hindsight is a lot easier, but I could have taken advantage of the early stage of the new bull run where valuations and opportunities were all over the place. So luck, it's there, of course, but overall, the timings itself, it's a zero-sum game, I would say, over multiple years. But, and let me come down to the most important point here. By doing so, by being more aggressive when opportunities became more asymmetric and more visible, and the odds were clearly in our favor, we were able to generate 5.5% returns on top just because of that. And how do we measure this? We measure this because we simply differentiate our returns from a time-weighted returns and a money-weighted returns. Time-weighted returns calculation isolate our discretionary decisions, meaning the exact deployments and withdrawals from our portfolio. They are isolated and neutralized. They are taken out of the picture. Whereas in the money-weighted return, this way of calculating the returns actually factors in our emotional decisions, our proactivity uh, expressed by deploying more money specifically during certain phases. And in my personal opinion, factoring in this emotional strengths, this emotional discretionary element is so important. It is wrong to express our returns in a time-weighted perspective because it's simply impossible for two reasons. Time-weighted return assumes that we invest all our savings, all our money at the start of the period, but physically this is not possible for many people, like for the vast majority of us independent investors. We don't take one lump sum at the very beginning and we stop investing from there. It will be way more probable that we deploy gradually, okay, and we have ownership, we have discretionary element and emotional impact when investing different sums in different times. And so the emotional aspect of this needs to take into account. It is absolutely important. And thanks to our emotional strengths, to our proactivity in the market, we were able to generate 5.5% more in the stock market. That is the second element that I wanted to clarify here. And with that being said, so we have a 14% with a 9% thanks to the beta and a 5% more thanks to our timings. As you can see, what's left to explain our 30.9% annualized, this difference is alpha. So whatever you cannot express with the previous two elements, what's left, it's alpha. And so it's not that high if you see how much it accounts. Alpha in my situation here accounts for 16% of the extra performance, when 51% is generated thanks to beta, and 30%, 35% from the discretionary timing, and 16% more or less from alpha itself. Now, keep in mind that a 2.93% extra performance per year alone is explosive in the long term. If you keep that extra performance in the long term, it seems tiny, but over 15, 20, 30 years, it will massively produce a compounding effect that you can see, of course, over a short time frame, like 5, 6 years, but over 15, 20, 25 years, that alone is enough to generate massive superior returns. Of course, we will see if we can keep generating this sort of performance, and there's going to be a lot to study. Of course, generating alpha is very tough, is very difficult, and it needs to be like if you are a proactive investor like me, every year is a new test, every year is a new challenge, of course, and that's why I prefer to always remain humble and not take anything for granted for the next years to come. Which brings me to the last part of this video, which is about a couple of friendly considerations here to make about the good and the bad of having this type of performance. And starting from the good parts and the positive aspects, they speak for themselves. I mean, we are generating very strong returns. We are leaving the markets without stress, without, of course, I wrote it down, without margin. Of course, I didn't mention this before, but I never used margin. I am never 100% invested. So I always have a cash buffer between 5 and 25% in the portfolio to take advantage of corrections and situations. So we've never been invested 100%, never went on margin, never will do so, hopefully. No time waste in 2023. We didn't make any move, more or less. In 2024, we made 25 moves in total. And in 2026, we were more active because there were certain stocks that uh, were approaching the end of their cycles. So we did a lot of selling to rotate the resources towards new stocks, a new generation of stocks inside the portfolio. So definitely 2026 has been way more active than the previous 3 years. But that's just the situation here. And we're doing so with such a very efficient system where we don't lose time, we don't waste time analyzing companies that are not worth the attention. We develop all our systems. We also have our alphas and platforms that in a few clicks helps us identify opportunities, plot risk reward, projections, analyze the fundamentals of our high priority names with a risk attitude and understanding the catalysts. And so we have, of course, topic for another video, but we have all the systems to run this with a minimal effort, but maximizing the quality of our decisions. And so we're having fun, we're having lots of fun, and I am personally way ahead of time when it comes to my early retirement and my career plans overall. I am 33 and I am currently on my way to possibly retiring between 45 and like 43 and 47, more or less. So it just gives me a lot of stability and a lot of happiness and a lot of, you know, confidence, never overconfidence, but a lot of confidence about my future. And that's simply the situation that I am experiencing today. Because I know that I don't have to keep these returns. I don't have to generate 30% per year. My goal has always been 15% per year. And if I achieve that, which I believe is very, very, very likely, not every year, of course, there will be setbacks, there will be bear markets. But if I'm able somehow to achieve our desired 15% per year, that is a very positive situation for the future. Now, of course, and let me close the conversation with this, there is also a flip side, which is not very pleasant, which is quite bad when it comes to this. Because when I am speaking about these returns to people who don't really understand investing, but also to people who are into this game since many, many years, it's sometimes hard to believe. Like a friend of mine told me once, what? Like 31%? Are you in the Coke aim business? Sometimes it feels quite t- perhaps too high. And in the world of online education, where all these gurus are taking the attention and telling you that they generated millions and whatever, I'm facing this risk of being associated to trading, short-term trading, and returns promises that are not possible to maintain. And somehow it's quite hard to differentiate myself from these people. I'm not saying anything. I don't want to say anything against anybody, but if I'm doing these raw conversations, videos, these pretty improvised ones, it's also because I want to show my transparency, my personality, my limitations as content creator, which I'm not clearly expert in. I just wanted to show who I am, and I honestly hope that by showing me my personality here this way, I can pass on to you the fact that this is real and this is actually what I am experiencing right now. The second part is that, of course, 31% per year, it can only go down from here. And, people anchor themselves to a number. And if, let's say, we have a bear market and my performance goes down to 25% per year, somebody's going to think, oh my God, this guy used to make 35, now it's 30, now it's 25. It's going down. This guy is not in the best, is not in his prime days anymore. And if I join him, if I join his programs now, what if this is just meant to go down in the future? So that's something that people might think. Will it work in the future? That's the biggest concern that people make, that like the biggest obsession that the people that I hear in the discovery calls or in the DMs, they tell me it worked in the past for you. Will it continue in the future? That's the main thing. That's pretty silly because as I told you, this is the most asymmetric situation in my current portfolio since 2022. So my portfolio right now is poised to having a minus 10% over 5 years to a plus 160% under very conservative assumptions, taking all the stocks overall in one picture, meaning I'm risking one to make 16. And that's the most asymmetric that I have been witnessing in the past 4 years, since 2022. So I'm super confident about the future years. I honestly think that the portfolio right now is in a position to double, if not triple, over the next 5, and that's what matters the most. And last but not least, why are you still selling your educational programs with these returns? You can just earn from the markets and forget about it. Well, this is, I don't know. It's hard to respond to this. Sharing all of this, sharing the tactics, the features, the platform, the agents, the supervision, and working with other people that want to learn this, that trust me enough to deserve, uh, so for me to deserve their time and their commitment to do this together. It's priceless. Let me say that investing, value investing, is lonely as F most of the times. So happiness can be shared. And if I'm able to bring value to the world and to other people with the same desires for early retirement, meanwhile having a strong personal development journey thanks to modern value investing, that's priceless. That's another story that doesn't need to be justified. And last but not least, luck with some outliers. Of course, I had some outliers, but that's the name of the game. Having three, four, five home runs is everything you need to achieve superior returns. That's not me. That's Warren Buffett saying this. And that's how it works. Protecting the downside and letting a few outliers take care of the losses and on the plays that didn't work out as you wished. Um, that's exactly the name of the game. That's, of course, there is a good portion of luck, but that's intentional. That's exactly what you need to achieve. That was the conversation for today. I hope you found value, at least one nugget to bring home today. Um, Again, if you're interested in knowing more in investing under my supervision, in understanding all the methodologies, the tools, the systems behind this performance, everything that I've been building for the past 5.5 years and sharing inside AlphaZen, the space where you can build high quality portfolios poised for superior returns without major and unnecessary risks. There's a link down below in the description. I'm happy to exchange ideas whenever you are ready. So thanks for this. It's been fun as usual, and I'll see you on the next one.